After 4 months of forgiveness, TIFF and our friends at the Bank of Canada have officially ended the rate pause. And the Bank of Canada is back to increasing rates with a 25 basis point hike today. But what does this mean for the real estate market and you? As a variable rate holder myself, I didn't really want to be creating this video, but here we are. CIBC had this to say. The Bank of Canada opted to act now rather than wait for a revised forecast, but its 25 basis point hike had the appearance of a fine-tuning move rather than the start of an extended addition to the prior course of tightening. Although it lifted the overnight rate to 4.75%, it opted not to state that with that additional hike, rates might not yet be high enough to do the job. This increase today really just goes to show that nobody really knows what's going on or what's going to happen. A lot of economists and news sources began their articles today by saying this move from the Bank of Canada was somewhat shocking and came as a surprise, but it was understandable. Myself personally, I thought continuing the pause was in order, but it appears the powers that be felt that with an uptick in inflation last month, they wanted to try to get ahead of another month of potentially higher CPI. CIBC also said today, we now expect a follow-up 25 basis point hike as a final fine-tuning, with September more likely than July due to the need to gather enough additional insights on the lagged impacts of all the rate hikes thus far. Neither of these hikes were in our prior forecast, but the bank's actions today signaled that it won't be quite as patient as we expected in its wait to see economic slack emerge. Again, it really just goes to show that nobody really knows what's next, and we can't predict the future. What's going to happen over the summer? Well, we're going to have to wait and see. What's interesting is that we're fighting inflation with inflation. When mortgage rates and housing costs increase, they add to inflation. But what is this 25 basis point increase going to do for the overall real estate market? In my opinion, it's not going to do a whole heck of a lot. It's not going to be the straw that breaks the camel's back. And I don't expect to see prices drop significantly. I think this increase in policy is going to impact sentiment, however. We saw as rates were paused, it fueled the market and consumers became more comfortable trading real estate. But with an increase, however small, people are going to be less comfortable making a large purchase, as there does not appear to be consistency in the bank's actions and the future is unknown. What does this mean for each individual buyer or mortgage holder? Well, if you're an adjustable variable rate mortgage holder, then you're going to see your monthly payments increase yet again. And it will be about $14 for every $100,000 of mortgage you hold. If you hold a fixed variable mortgage, then you're likely going to see amortizations extended. And for those currently on a fixed rate mortgage, meaning the payments are static, then this doesn't really impact you at all, for now. If you're currently looking to purchase a home, you're likely not electing to go with a variable rate mortgage, which means you either have a rate hold from before the bond yields went up, which would be amazing, or you are going to have less purchasing power. As it has in the past few years, the market will press on. So what can you expect if you are buying and selling in the coming months? Well, if you're purchasing a home, you can expect less competition simply because people are going to be more hesitant with their real estate purchase and may back away from the concept entirely. And if you are someone who locked in a rate before bond yields went up, then you are now in a pretty good position to possibly negotiate and may have more buying power over your competition who did not lock in a rate a few weeks ago. Now, on the flip side, if you're selling, you're definitely going to see less activity on your property than what you could have experienced back in early May. And I say early May because we were already experiencing a little bit of a slowdown in the latter half of May. But are prices going to drop off a cliff? I doubt it. We're going to see less market activity in June and July than we did in the spring, which is expected, rate hike or not. And I think we'll start to see less discretionary spending on real estate. We're already seeing fewer home renovation permits being taken out, and I anticipate those searching for investment properties and or recreational properties will sit back a bit. And that kind of makes sense because those types of purchases are not necessary in order to put a roof over their heads. And these rate hikes continue to divide people into two camps. One of people who want rates to increase for housing prices to come down in order to buy something more affordable, and another camp of people who want rates to be lower. And the interesting thing here is that neither of these groups of people are winning. Rates increased over the past year and prices dropped, but housing did not become more affordable on a monthly carrying cost standpoint. And even over the last few months, rates stayed the same and prices still increased. And those who want rates lower continue to feel the pain. The only real winners in this equation are purchasers paying all cash and not obtaining a mortgage. They're the real winners because they're taking advantage of lower sale prices without the burden of a higher mortgage rate. Where do you sit within these camps? Do you want to see rates rise more, or do you want to see them drop? I mentioned this earlier in the video. Life is not on hold, so those who want and need to move will still do so. A lot of my active clients right now are move-up buyers, and they're moving up for a specific personal reason. And we'll continue to see these types of people in the marketplace because they're not willing to put their lives on hold. They want a different home, so they're going to make it happen. And since we already began to experience a slowdown in late May, we'll continue to see the same trend into the summer. And the bank is likely to take credit for it, to be honest. So we'll need to look at the historical numbers during and after the summer to compare the market activity. The impact this rate hike has on the market is very small, but it certainly will impact consumer sentiment. Thanks for watching. If you have any questions or want to chat, head to the first link in the description to book a meeting with me.